Welcome to the Retirement Guy Podcast with Gary Alden from the Kingwood Investment Group. In this podcast, we educate people in or near retirement so they can make informed decisions and bridge the confidence gap. Learn how to mitigate risk in retirement so you don't run out of money before you run out of you. Join Gary Alden and explore strategies on how to live a stress-free retirement.
Hello and welcome to the Retirement Guy Podcast with Gary Alden from Kingwood Investment Group. Thank you so much for joining us today. Good morning, Gary. How are you?
Good morning, Eric. We are terrific, but like I usually say, we make it better.
There's always room for improvement, Gary. I appreciate that. All right. So what are we doing today? I know you've got something a little bit different this morning.
Well, we're going to do a quick review of the bucket plan, but before we get started on that, thought we would start out today with a trivia question.
All right.
In fact, this is my most favorite trivia question because it hits close to home. It involves my father-in-law, who was a World War II veteran. And here's the trivia question. How many atomic bombs have been dropped on the United States? Now, notice I said the United States. I didn't say atomic bombs dropped on Japan, which I think everybody knows about. But how many atomic bombs have ever been dropped on the United States? And at the end of the podcast today, we'll give you the answer.
All right. Are we talking about like bombs that were actually physically dropped, or are we talking about ones that were tested?
Bombs that were dropped from an airplane.
Okay. I've got a number in mind, but I'm going to keep that. It's really low, like 0, but I'll wait to the end and find out your answer because I don't know of any. So we'll go from there. All right, so let's do a review of the bucket. I'm going to be thinking about that this entire podcast, Gary. Thank you very much.
Okay.
So let's go to a review of what we did on the last podcast about the bucket plan, and then that'll bring our listeners up to speed that didn't hear that. I encourage you to go back and listen to it because it's valuable information. But give us that review, and then we'll move on with this podcast.
Okay, just kind of remind everybody, the bucket plan is a philosophy of investing your money to mitigate risk. And you can read all about it in a book called The Bucket Plan by Jason Smith. It was an Amazon bestseller. And it is the way that myself and my colleagues here at Kingwood Investment Group, this is how we like to invest clients' money because it helps mitigate risk of your money in retirement. Simple as that. So the three big risks, kind of a review of the last time, there's market risk. We all know the market goes up and down. There's inflation risk because we all know the cost of a loaf of bread, jug of wine is going to go up over time. It's built into the system. And then the last thing, but most people have never heard the term, is called sequence of return risk. That's a little bit more involved, but basically it's, if you just retire and it was 2008 and your first year of retirement, the market goes down 40% and you're retired, you're probably pretty nervous about your retirement. So really, sequence of returns gets down. When do you have your gains? When do you have your losses? Those, we think, are your three biggest risks: market risk, interest rate risk, sequence of return risk. And again, by using the bucket plan philosophy, we hope to mitigate all those risks and maybe give you a little bit more worry-free retirement. So if you look back, this is a thing that we cover in the book. There's a gentleman named Harry Markowitz, and he developed a thing called modern portfolio theory. And he won a Nobel Prize, and basically his Nobel Prize that he won back in the 50s was don't put all your eggs in one basket. In other words, you have a large cap mutual fund, a small cap, a mid cap, you have some money in cash, you diversify.
Yep.
And the guy won a Nobel Prize in economics on that. And we've learned a lot since he did that in 1952. And what we learned when it comes to investing, people are not always rational. Investors and sometimes their advisors think they can beat the market, but they often end up buying high and selling low. They panic during times of volatility, sell off their holdings, take losses, and then they sit on the sideline and maybe miss the recovery. So again, what we're trying to do in the bucket plan philosophy is to maybe reduce those types of risk and that type of behavior. So again, just quick review, the three buckets. There is the now bucket, the soon bucket, the later bucket. The now bucket, that is your safe and liquid money that you need for emergencies,
Okay.
Maybe the water heater bust. You need a new roof on the house. The car craps out. You need a new car. Maybe short-term planned expenses. You've got a wedding coming up, maybe tuition for children or grandkids. And then income that you're going to need the next 12 months because you just retired or you're close to retiring. In other words, this is your safe and liquid money. You're willing to give up any appreciable earnings or gains on that money for the sleep well at night factor that you have that money at all times. The next bucket is the soon bucket. This is the conservative money that has three purposes. This is money you're going to need in about the next 10, maybe 12 years. It's conservative growth, not subject to sequence return risk due to market risk and interest rate risk. You may be taking income or withdrawals for that first 10 years of retirement. And then also it provides an inflation hedge so your money stays up with inflation because we all know stuff's going to cost more in the future. Then the last bucket, which is the long-term bucket or the later bucket, this is your legacy planning. Money in the latter bucket really has several purposes. One, growth and income for your second phase of retirement, and then also legacy planning. And it's not just legacy planning to leave money to the kids, it's also legacy planning for the surviving spouse, because we're presuming one spouse is going to predecease the other. So the basic buckets we're dealing with, the now bucket, safe and liquid, the soon bucket, conservative growth, and the latter bucket for long-term growth and legacy planning.
Great. Thanks for the review. And before we get into today's podcast, I want to remind the audience that the Bucket Plan by Jason Smith is available on Amazon for about $20. You can get on there and order it. Or, more importantly, if you reach out to Gary, make an appointment, just stop by his office, he'll give you a copy for free.
Best deal you're going to get all day.
Absolutely. All right.
Free is as low as I'll go.
Free is good. We like free. So today's podcast, what are we getting into?
Well, I want to cover again the three types of money, maybe a little bit more in depth than we did last time.
Okay.
There are three types of money. There's taxable, there's tax deferred, there's tax free. And I think we would all agree tax free is the best kind of money.
Again, free is good.
Free is good.
Yeah.
So taxable money, that's money you'd have in a brokerage account, investment account, your stocks, your bonds, your mutual funds, maybe CD money, money market money, money that is taxable currently and it's pay as you go. So that would be subject to long-term and or short-term capital gains. Then you have tax deferred. And again, key word here is tax deferred. It's not tax-free. It's that you're putting off paying taxes. You're not paying the taxes today. You're going to pay taxes later on when you retire. The two most common examples of that are your IRA accounts and 401k accounts at work, maybe a 403b account. Also, you might have at work. So the government is not taxing you on that money today, and they're saying, hey, 20, 30 years from now, then we'll tax you. The only problem I've always had with that, what are they going to charge me in taxes in 20 or 30 years when I do retire?
Yep.
They have the power to raise my taxes, so you're buying a pig in a poke. And then the last thing is tax-free money. And there's four ways to get tax-free money. There's Roth IRA accounts. There's Roth 401k accounts. Now, most people haven't seen Roth 401k accounts, but they just started to become popular just in the last probably 3 to 4 years. But more and more companies are offering a choice of putting in money in a Roth 401k account. And the other two things that you could invest in that could be tax-free, one is properly structured, keywords here, properly structured cash value life insurance. Properly structured could give you tax-free income in retirement. And then the last thing that most people don't think about is a reverse mortgage. Because if you do a reverse mortgages, and there's pluses and minuses on reverse mortgages, again, the money you get from a reverse mortgage is tax-free. So again, three types of money: taxable, tax-deferred, tax-free.
Gary, can I ask you a quick question about the reverse mortgage?
Yes, sir.
There's a lot of companies out there. We see infomercial after infomercial about reverse mortgages. I'm not going to ask you to name any companies or anything, but is that something that they can, if people are interested or have heard about that and have questions, can they reach out to you in your office and get those answers from you without having to call the company off the infomercial? Because I don't know if I trust them because we don't know them.
Yes, and you're exactly right. There's a lot of ifs, ands, and buts on reverse mortgages, and the government has gone in and cleaned it up because at one time reverse mortgages were the wild, wild west. There's a lot of government regulation on them today.
Okay.
But again, you need to go in with your eyes wide open on those things. In fact, under current federal law, you can't just go get a reverse mortgage unless you attend a consumer education class beforehand. You actually pay money for it. It's usually around $100. They want people to understand what a reverse mortgage is and what a reverse mortgage is not.
Got it.
Again, it's like anything else. It's just a tool for retirement, may or may not fit your situation.
Okay, thank you.
Okay. So again, we've all heard about being diversified in your investments. You own a large cap fund, a small cap, a mid cap, international. You got maybe some CDs, you got some money. You are diversified within your assets. But what most people are not is they are not tax diversified. What I see consistently is someone comes into my office and they've worked for a company the last 30, 40 years and they say, Gary, here's my nest egg. What am I going to do with this? How do I create income? And by and large, all their money's in a 401k plan or all their money's in an IRA account, which means it's going to be taxed at ordinary income rates when you retire, which is the highest tax rate. Most people don't have money in brokerage accounts. Most people don't have money in tax-free investments. So if I can get to somebody 5, 10, 15 years before they retire, and let's start doing some tax diversification, you are going to be miles ahead in retirement and have a lot more money to spend on that fun stuff we all want to do in retirement.
So less to the government and more for retirement.
Oh, yes. And the government is not your Uncle Sam. That makes it sound like he's a nice guy.
He's your buddy. Who's your buddy?
Yeah, he's not your buddy. It is the Internal Revenue Service.
Yeah.
And if anybody out there in the audience has ever had to deal with the IRS, I've had to deal with IRS on personal audits as well as business audits. They have zero sense of humor. They don't see anything in shades of gray.
Yeah.
Everything is in black or white. And it is no fun to go through an audit. But it's also no fun to pay a lot of money in taxes in retirement. But again, you need to start early and plan for tax diversification.
Okay.
Okay. We've gone through tax diversification. Again, kind of remind everybody what the bucket plan is. You're buying a time horizon, and then you're investing the rest of the money. So again, if we go back to that soon bucket, somebody comes into my office and we set up a bucket plan. In that soon bucket, we're probably going to put enough money into that bucket to give conservative income for the next 10, 12 or more years of retirement. So if the stock market goes down the first year of your retirement, you don't really care long term. I mean, you care that it went down, but the money that's subject to the market ups and downs is in your later bucket. And we are not going to have to tap into that bucket for 10, 12, 15 years. So if the market does really have a bad year, 2008 is a good example. You retired in 2008, you saw your investments go down 40, 50%. You really are not that concerned because you don't have to tap into that money, which is in the later bucket, for 10, 12, 15 years. So we buy time to give time for that bucket to recover. Does that kind of make sense?
Absolutely. And we did see that. We saw a lot of that market recover, but it took a couple of years. But it didn't take 14 years or 10 years. It only took a few. So that later bucket would replenish fairly quickly in that situation.
Exactly. And when you read the bucket planning book, and again, I stress everybody, it's an easy read. It is designed, and it was designed on purpose to read in the course of a typical 2 to 3 hour plane ride. It really is about a 2 to 3 hour read, and we leave out jargon. I can give you all kinds of financial jargon, but we talk about it on the consumer level, and it is also told in story form. We give you a story form about real people, real investors, and real life situations.
Got it.
Okay, so we buy time horizon, invest the rest. Now, here's what the bucket plan is trying to do. It is trying to mitigate or control or help clients not do the wrong thing. In other words, we're trying to avoid bad behavior with clients' money. And we know clients will do, and I've been doing this since 1994, and I've seen a lot of people do things with their money against their best interest because they let their emotions control their daily investment activity. And again, that's what the bucket plan is trying to avoid. So we've identified 4 key behaviors. One is many investors and sometimes their advisors think they can beat the market, but they end up buying high and then selling low, which of course is the exact opposite of what you're trying to do with your money. Number 2, many investors panic during times of volatility and they sell their holdings and take losses, and then they sit on the sidelines and then they miss the recovery. A lot of people did that in 2008. Maybe some people, I'll bet you there's some people on this podcast, did that. They sold low and then they waited for the market to go back and they sold high. I've actually had customers tell me, you're waiting for it to recover and go back up and then you're going to buy? And they said, yes. So I said, you're going to sell low, yeah. And then you're going to wait till the market goes back up, yeah. And then you're going to buy high. And they sit there and nod their head. I said, do you buy your clothes at the department store that way? You don't want to buy it when it's on sale. You want to buy when it's at regular price?
Yeah.
The third behavior, and this is one I love because there's some study behind it. Many investors, and again, sometimes their advisors, let the possibility of bad surprises impact them more than the potential for good ones. And here's a good example. This happened over 50 years ago. There was a very famous Nobel laureate called Paul Samuelson. And he offered one of his MIT colleagues a bet on a coin flip during lunch one day. And he said, if you choose heads and it comes up heads, I'll give you $200. But if you call heads and it comes up tails, you lose $100. And his colleague rejected the bet. He said no. Now, here's what his colleague said. He gave his reasoning for rejecting the bet. He said, I won't bet because I feel the $100 loss is more than the $200 gain. People hate loss much, much more than the potential for gain. It's an interesting study, and that study's been done dozens of different ways over the years using different scenarios, and it's always come true the same thing. People hate loss many, many times more than they like the gain or the possibility of making money on their gains. Then the last bad behavior of clients, again, and this is what the bucket plan addresses, is many investors lump their investments together without separating the money they may need for soon from the money that they can dedicate to a longer term commitment. And again, the soon bucket for conservative income, the first 10 or 12 years of retirement. Then we want to segregate, put some money in that later bucket for long-term growth and also for a legacy planning. Okay. So again, what we're trying to do in the bucket plan is we're trying to avoid bad behavior with their nest eggs and again, mitigate the risk of loss in retirement and mitigate the 3 biggest challenges we face in retirement. And that is the 3 of interest rate risk, market risk, and sequence of return list. Eric, now we are going to drill down and look at what someone could experience coming into my office.
All right.
And that is the 6 steps of bucket planning. We've covered a bunch of them today. Number 1 is we're going to go through the money cycle again. We're going to talk about the bucket planning philosophy, buying time horizon, investing the rest. The client is going to complete an asset worksheet. So I have a thorough understanding, and the client has a thorough understanding of their financial situation. And we're also going to be estimating their tax liability so we can look at what kind of money they're really going to have to spend in retirement. Mm-hmm. It also helps us look at someone's estate down the line, and that would help their heirs settle their estate in the most tax efficient manner. The next thing is an income gap analysis. And that is it's a simple one-page tool, and it calculates how much money you're going to need for daily living in retirement and identifies where that money's going to come from. And it's much, much simpler than creating a full-blown budget. Mm-hmm. It also helps us identify if there's any excess cash flow in retirement, making it possible to give even more strategic or getting more strategic with your tax planning and your investing. Step number 5 is the volatility tolerance analysis. That's a mouthful.
Yes, it is.
It measures your tolerance for risk and market volatility in each particular bucket, so we can create a customized bucket plan that stays within your comfort zone, not your neighbor, not your cousin, not your Uncle Fred, while simultaneously helping you reach your goals for long-term growth. So this tool is different from the one that most other advisors use because it measures your tolerance for volatility on the soon bucket, on the now bucket, and also the later bucket. Okay. So it's a great tool for us to use with clients so we understand where you're coming from. Again, not your neighbor.
Yeah, it sounds great.
And then step number 6 is then once we have all that information from step number 1, 2, 3, 4, and 5, then we design a personalized bucket plan for you.
Okay.
So that's the 6 steps of bucket planning. That's a very, very good overview of the entire bucket plan process. But again, like we mentioned earlier, the book is a great tool for really drilling down so you can fully understand what the bucket plan is all about so you can be comfortable with it.
Gary, should somebody read the book before they come in for the 6 steps of bucket planning with you?
They don't have to, but it's not a bad idea. But what I do ask clients to do, because our first meeting, we are collecting information from the client. I always, worst case, hand them the book at that point and say, please read this read this book between today's meeting and our next meeting, and you're going to get a lot more out of the next meeting because you'll understand where I'm coming from.
Yeah, that makes sense.
And it's going to make the second meeting a lot more impactful.
Great. Well, do you have any closing thoughts about the bucket planning for this podcast?
Not any more about the bucket plan itself. The one thing I do want to cover before we leave is the answer to the trivia question. And that is there's actually been 3, let's call them atomic bombs, dropped on the United States over the years.
Okay.
The last one was in 1961. There was a U.S. aircraft flying over North Carolina, developed a malfunction in the plane, had to crash, and aboard the plane were 2 nuclear bombs. Luckily, they didn't go off, or a good chunk of North Carolina may not be here today.
Oh, my gosh.
But the one that's closer to home happened in 1957. My father-in-law, Lieutenant Colonel Richard Meyer, was flying a B-36 in the Albuquerque, New Mexico area, and it was an equipment malfunction. And literally the plane was flying over Albuquerque. The bomb dropped out of the bottom of the plane. And they believed that the chains that the bomb was suspended from, one of them broke loose, and the bomb fell through the bottom of the plane. Luckily for everybody in Albuquerque, the atomic bomb itself didn't go off, but the conventional warhead did put a huge hole in the ground, killed a cow, literally killed a cow. You can read all about this on the internet. But the farmer outside of Albuquerque was sworn to secrecy by the U.S. government. And then a few years ago, it was discovered, the event was discovered by a news team and through the Freedom of Information Act. So my father-in-law became famous, was interviewed, and sitting in his den there in El Paso. and my father-in-law got his 15 minutes of fame on dropping an atomic bomb in the United States. So it's really happened twice, one bomb in 1957, two bombs on the same plane in 1961. So, hey, if you're ever on Jeopardy and they ask you a question about atomic bomb dropped on the United States and you answer the question right, yeah, maybe send me a check.
Yeah, how do you tell that farmer that his cow was killed by a weather balloon? That's what I want to know. I want to know how that conversation went down.
Yeah, that weather balloon over in Roswell. Yeah, that's the ticket.
That's it. Oh my gosh. Well, I encourage everybody to get the book, The Bucket Plan. It will definitely help you in the long run and short run with your planning. Get it free from Gary. I mean, that's the best way to do it. He's open to it, open to the conversation. Gary, how can people get a hold of you?
Real easy. They can send us a question, go to our website, the KingwoodInvestmentGroup.com, just www.thekig.com, or just call us here at the office. We're at 281-359-7900, 281-359-7900. You'll talk to one of the three nicest people in the world, Jill or Rachel or Aurora, just super, super good people. They make me look good every day, and they're the real brains behind the operation.
Fantastic. Hey, thanks everybody for listening to today's podcast, The Retirement Guy with Gary Alden. If you have not subscribed to the podcast yet, please click the subscribe now button below. This way, when Gary comes out with a new podcast, it'll show up directly on your listening device, and that makes it so much easier to share these podcasts with your friends and family. I'm hoping that you share that trivia question with your friends and family as much as you share this podcast with them, because my number was 0. I never thought that there would be any atomic bombs dropped on us. But again, thanks for listening today. For everyone at Kingwood Investment Group, this is Eric Johnson reminding you to live your best day every day. We'll see you next time.
Thank you for listening to the Retirement Guy podcast. Click the subscription button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Kingwood Investment Group. The content has been made available for information and education purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions that you may have regarding your investment planning. Kingwood Investment Group is independent of Next Financial Group, Inc. Securities and investment advisory services offered through Next Financial Group, Inc., member FINRA/SIPC.